Here's a bunch of tax law issues that you need to be aware of in the middle of 2024. Now, first off, a lot of you guys, if you're an investor, you know that there's the phase out of the accelerated depreciation, the bonus depreciation that we've been enjoying for the last few years. It's 60% this year. The House in Congress has passed a provision to fix that and make it 100%. Senate is talking about taking it up. Biden's been non-committal as I sit here today. I don't know what's going to happen. If I was a betting person, I would say that it's probably going to come back to be 100%. It's supposed to be retroactive. So if you're a real estate investor and you're investing in real estate, there's probably more likely than not that you're going to get to that 100% bonus depreciation that you use when you're doing your cost seg. So just be aware that as of right now, it's still at that 60%, and that you may want to look at that. Other thing, in the Secure Act 2.0 in 2024, some provisions came into effect that actually affect early withdrawals from retirement plans. And there's this 10% early withdrawal penalty if you take distributions out of an IRA before you're 59 and a half. And it's not just IRAs, it's 401ks, it's retirement plans. Let's just be real. So this is going to have a pretty big impact on people who had a legitimate need to get that early withdrawal. And there's a few exceptions that came into play. First off, there's a emergency personal expense exception, which is the purpose of meeting unforeseeable or immediate financial needs relating to necessary personal or family emergency expenses, which means you just have a whole bunch of stuff that could cover. If you need it because of a family emergency, then you wouldn't be subject to that 10% penalty. It's still taxable, but you're not getting hit with that penalty. Another one, you're going to have a domestic abuse exception, which is if you are the victim of domestic abuse, you're able to take up to $10,000, up to 50% of your vested balance, whichever is less, and not have to pay that 10% penalty. So if, unfortunately, you're in that situation, it could be, by the way, domestic abuse could be physical, psychological, sexual, emotional, or economic abuse, including efforts to control, isolate, humiliate, or intimidate, or to undermine the victim's ability to reason independently, including abuse of kids, if they're even using the kid to control you. And you have the option of repaying that money within 3 years if you want to, gets it back into the retirement plan, but you're not going to be subject to that 10% penalty. There's a terminal illness, which is you're expecting death within 7 years. That also will eliminate the 10% penalty. There's long-term care exclusion, which I don't believe that's actually taking effect in 2024. It's there. But I believe that that's actually going to kick in 2026. But just be aware that it's rolling around out there. And there's some disaster recovery exceptions, and there's an over the age of 50 exception for public safety workers that are also out there. So there's several exceptions to that general rule that you have a 10% penalty. There was also a bunch of new provisions added on NFTs, which, if you're not familiar with non-fungible tokens, it's basically it's a kind of a virtual depiction, something that means that the NFT is unique, and thus they're different than Bitcoin and other things. And that token is a digital code to provide proof of ownership of that NFT. So you have these tokens, non-fungible tokens, and they're treated as collectibles underneath the Internal Revenue Code. What does that mean to you guys? It means that, hey, there could be issues holding them in a retirement plan, for example. And also, you're going to be taxed at the 28%, this weird capital gains rate on collectibles. So just be aware that when you're purchasing, selling them, gifting them, that there's these issues. By the way, if you gift it, the IRS is still taking the position that it's a collectible, but it's kind of like a capital gain, where my basis, whatever I paid for that NFT, and I gift it to somebody else, the basis is my basis. They're going to pay that 28% tax on the gain. That is the amount different than my basis and the amount that it sells for. So that could be something that you actually have to deal with if you are gifting some of those NFTs. If you donate it to charity, well, there's special rules with collectibles. So for example, if I'm giving something to charity, I get a fair market value deduction, but I believe if they sell it within 3 years, you only get the basis. So it's one of those weird things where, shoot, I write it off the year that I make that donation. Let's say I had a NFT that ran up in price. I paid $1,000, it went up to $10,000. I'd get a $10,000 deduction. But if that charity sells it within the next 3 years, I have a little bit of an issue. I'm only going to get the $1,000 deduction instead of the $10,000. So be careful of when you are donating those NFTs. So there was a bunch more to the NFTs, but it's one of those things where I don't necessarily want you to get into the weeds on it. Another issue is we had this 100% meal deduction, and we are back to the 50% deduction for meals. Now, meals have always been an issue for the IRS. They tend to think that you're going to abuse this because you're going out, and they want to make sure that there is a legitimate business purpose. And even more so, they've been selectively nailing people on the idea that it's not actually more expensive what you're buying when you're going out for the meal than you would have ordinarily incurred if you had just for a personal meal. In other words, you have to actually show that you're spending more on the meal as a business reason. Now, this was never an issue before, but there was actually a case. It's called the Sutter Rule. And in Dr. Sutter, I believe that he was going to, gosh, what was he doing? I think he was going to the St. Louis Chamber of Commerce and Hospital Council and was paying a little bit for their luncheon meetings. And they said, you would have paid that anyway. It was such a small amount. We're not going to give you the deduction. And what they do is they say, what's the amount of the personal deduction? And that's, you don't get that, what the personal expense would have been. So it's only the amount that's in excess of that. We don't see it very often, but we're seeing it come up enough to where it's like, hey, you know what? The IRS could just at its we call it whimsical, right? At its whim, actually, a CPA that writes on this stuff called the Sutter Rule a whim, because it's basically a tool that's in the IRS's toolkit that they can just pull out on their whim and hit you with and say, your meals aren't really expensive enough. You're not really doing stuff. But all you have to do is show the business reason of your meal, who you were with, why you were with them, that you were expecting profit out of it, and that they were that you spent more on the business meal than it would have cost you to have, let's say, dinner personally. And again, if it gets too cheap, you could have an issue. But you got to make sure that you're documenting this just in the event that it pops up. Another thing that we're seeing a lot, in the IRS stopped processing earned employee retention credit claims, these ERC. You were hearing them all over the radio. You could be entitled to the employee retention credit, blah, 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 right? And they were making a bunch of fake claims. I've had some folks that I know that got bad advice, and basically what happens is the IRS audits you and they say, you were not entitled to this, give us back our money, or we're going to beat you over the head and charge you penalties and interest. And the problem is the group that you paid, they have language in those contracts that you signed that are basically saying you still owe them the money. Even though they were oftentimes taking a percentage of whatever they were recovering, you're going to end up paying that thing back if you weren't entitled to the employee retention credit. What bothered me was that they stopped processing claims, because, why would they do that? You should still be processing claims for taxpayers. Why are you beating up on all the taxpayers when they didn't do anything wrong? So why are you punishing all of them? So those are the big ones that we're seeing that are the tax law changes. There's looming out there is the Tax Cut and Jobs Act, sunset in 2026. So we have a whole bunch of provisions, including the standard deduction, the state tax, a bunch of provisions that affect businesses and individual, including, I think the corporate rate's not subject to this, that 21%. But everything else, there's a lot of provisions that are sunsetting that you need to be aware of, and we got to be watching for, because in 2 years they may go away. And all of a sudden we're like, gosh, bless it. You're going to see Congress taking this up and wrestling with it. because the one thing that the Tax Cut and Jobs Act really did do is put more money back in taxpayers' pockets. And if you allow them to expire, you're going to see extra taxes levied on the populace, and they're not going to be too happy about it. So if the Congress sits on its hands, puts them underneath their butt, and doesn't do anything about this, you're going to see tax increases in a couple of years. So what do we do about it? Well, you could push your congressman, you can write your congressman, you can make it an issue, or you could take, you start planning for it, saying, hey, what happens? So for example, in estate planning, we could see the estate tax exclusion, which right now is over $13 million per person, go down to that $5 million level plus inflation, probably $7 million. So you're going to see that thing get cut in half. And for estates that are above, let's say it's over that $10 million mark or $14 million mark with inflation, it's 40% on a hit. So if you're in that $20 million range, or you're in that $17 million range, $16 million range, $15 million range, I know it sounds like a lot of you guys are just tuning out going, yeah, you're talking to the rich people. No, you have a business, you have real estate, you are getting hit with taxes on something that you're probably going to have to liquidate to pay the tax, or your heirs will have to. And so there are things that you can do to avoid that by taking advantage of the higher estate tax rate now or in the next year or two. Like, you're going to want to watch that and talk to your planner, because you may want to take that gift at the current level. You can use your lifetime gift and get it out of your estate. Otherwise, you may be in a situation where you get hit with a large estate tax because it sunsets, and all of a sudden we're looking at it. Or Congress, there's been discussion about reducing the estate tax exclusion down to 3.5. You may want to do this ahead of time. It depends on your situation. Everybody's different, but it's worth a conversation with your planner to see whether or not you could avoid a pretty nasty tax hit by doing a little bit of planning ahead of time and making sure that you're not subject to some sunsetting laws in the Tax Cut and Jobs Act. So those are the big ones, guys. I'll keep you updated if any more come out. If you could do me a huge favor and like and subscribe, and even more importantly, put some comments as to how you feel about Congress either changing the laws and extending the Tax Cut and Jobs Act. Maybe you say, yes, they should be extending the Tax Cut and Jobs Act. And more importantly, whether that they should right now, whether you think it's a good idea for them to increase the bonus depreciation and pass legislation to make it 100% again. That benefits all of us real estate investors. Hopefully that's you too. If you could do that in those comments, it really helps us. And if you could share this with somebody that you think could benefit, that would be great as well. Thanks.